With us now is Jeff Small, president of Arbor Financial. Jeff, great to have you on the show. So last December, we have to think back, it was pretty ugly, an absolute nightmare for Wall Street. What's your prediction for this month, given that we're just 10 days away from some pretty substantial tariffs being implemented?
Wow, there's so many variables this month that can impact the markets. I think the biggest one is there going to be trade tariffs levied on December 15th, or is Trump going to punt since there's really no scheduled meetings between China? I see the markets kind of flattening out for the rest of the month, despite the fact that there's no China trade deal and also there's no USMCA deal. With those two things can start to make some progress, I think we'll see the markets kind of lift up here, even though there's lots of good information out there in terms of what's affecting the markets. Really, we're waiting on also what the Fed is going to do next. What the Fed is going to do is the big question, and nobody has any idea. A little bit of a rate decrease would be nice, but I don't see it happening with Operation Twist in place to suppress the yield curve inversions that have been occurring.
Right, and we had heard Jerome Powell, even outside of the official meeting minutes in this press conferences, speak on what next year looks like, and there seems to be sort of a holding pattern, and depending on how things go, even with our economy, he has really indicated that there might not be future rate cuts. So how much of that do you think is also baked into the forecast of these companies going forward, and even the markets?
Well, we have had a couple of rate decreases, and I think that's really helped the market. We see debt refinancing, the cost of lending is decreasing. It's improving consumer sentiment as well. And so, I think the Fed will lever that out as necessary over time. But I think the markets are really in a buy mode right now. Sentiment is very positive. And despite what's happening politically here domestically, despite what's happening with the China trade deal, we are in a buy mode. The market wants to continue to melt up as long as earnings are good.
So what could derail this melt up, Jeff?
Well, putting the tariffs on December 15th would be the first thing that could, really decide what happens.
So I guess, yeah. So I want to interrupt you there because I want to make sure I understand how you're thinking about things right now.
Sure.
To what extent are December 15th tariffs priced into what we're seeing right now?
Well, I think that the market's already priced in. We're up 25% on the, or 20% on the S&P year to date, 16% on the Dow. I think the market's already priced in any kind of positive inertia or gelling that's going on between China and the Trump administration, even though nothing's happened. I don't think the market goes down from here, except with putting the tariffs on. If we see tariffs get put into play December 15th, which is probably not going to happen, almost guaranteed, but if it did happen, we'd see a 10% correction in December.
Okay, and let's say we do get to December 14th and everything is fine and they somehow do not get implemented. Does the market have more room to go?
Well, I think it's got a little more room. I think the market's kind of hit the wall here. 90% of the market is at its all-time high or higher, and that's just a big problem right now. I mean, the market has, how much higher can it go? But there's no place to put money today. Rates are collapsing. The Fed is stimulating the interest rate curve, and that's creating a buying frenzy in the market because there's nowhere else to go. Plus, earnings are good. And so when you have that dynamic with strong consumerism, it propels the market up. Could we see a 5% growth in the market over the next month or two? It's possible if the optimism keeps occurring and the magic keeps occurring and we can see a phase one China trade deal, that would really lift up the markets from here.
Well, as you mentioned, Jeff, the consumer is sort of the all-star, absolutely, of this economy right now. What concerns do you have about consumer confidence or potential consumer spending going into 2020? What should we be able to look out for?
Well, I think that for 2020, we're kind of at the top end of the unemployment rate. That's usually a late stage or late cycle indicator of the expansion. The Fed is going to keep giving life support to that expansion. I don't see, unless we see a recession or employment layoffs or a decline in earnings, I don't see the consumer sentiment changing at this stage of the cycle. We've got too much inertia. It's going to last through 2020.
Right, and we know that, of course, when it comes to the forecast that we've seen for earnings that have come out for even this quarter, a lot of those forecast numbers, those predictions for results were lower than what actually Wall Street analysts expected. So, I mean, what does that say when the strongest quarter for consumer spending, for these companies to make money, are even coming in or have already been set at a lower rate? Do you think that's just a factor of these companies playing it safe so they can more easily clear their results come January, February, and March?
Well, I think it's more of an indicator of the political risk quotient as it relates to what corporations are going to be spending in 2020 as we go through this ginormous political struggle in our country. It is going to end up affecting what corporate America does, and that includes CapEx spending and maybe even stock buybacks. Even though stock buybacks, they've added almost $2 trillion of market cap in the last 24 months to the market from stock buybacks alone. And so we have this huge squeeze play on the float. And we have half the companies we had in the market 20 years ago we have to do for trading. So lower float, less companies, more demand equals share price increases.
So Jeff, how should people our age, millennials who are watching, think about their involvement in the markets right now?
Well, millennials have the luxury of time. So if you're going to be an investor like Warren Buffett, you want to find a good value stock at this stage of the game that's going to pay a good dividend, that has a good dividend growth rate, that's going to be resilient in an undynamic economy, because at some point the economy will slow down, it will vacillate, we will go to 0% growth or less for 2 consecutive quarters, hence a recession. So you want to get a good value play in the markets right now with a stock that's going to have a good track record on dividend growth.
Well, but to your point, you just said there's really not that many places where we can put our money. So maybe give us some specific sectors to look at, or maybe some specific themes as well.
Well, if you're a millennial, obviously you love the tech sector. And I've thought for a long time that Apple is undervalued. I still think that Apple is undervalued. I think if you're a millennial, I think you're foolish if you don't have Apple as a core part of your portfolio. On the value play, I look at stocks like Verizon. Their growth dividend track record has been much stronger than their actual stock growth. It's a solid company. It's going to be around a while. I think from that perspective, that's kind of how you balance between growth and various, value plays or dividend plays.
All right, great stuff, Jeff. Thank you as always for being with us. Jeff Small is the president of Arbor Financial. Thanks again.
Thank you.